All right, so we're going to proceed with risk management as the next section. Okay, so in risk management, there are two elements we are looking at. So from the same official terminologies, looking at the process where, as an organization, we tend to understand and manage the risks that are inevitable to us. Okay, so those risks, when we permit them to operate or to exist, they will hinder us from achieving our objectives. Now, two elements come in here: conformance, okay, and then performance. In conformance, we are talking of controlling the threats, the hazards that may occur. Bad things could happen to us. But in performance, we're also maximizing our returns and opportunities. Good things may not always happen. So the little we have, we take advantage, we capitalize on that, and we use it for our own advantage. Okay. So two elements play a role in risk management, which we need to take note of. Okay. Now, enterprise risk management, and I always go for the COSO 2003 definition because it gives us all the key elements that we need to look at for. So it's a process normally initiated by the board of directors or the senior management and other responsible officials. Sometimes you have a risk manager who is in charge of that, and they are applied in strategy setting and across the entire entity. Normally, these are designed to identify potential events that could affect us adversely, okay, sometimes positively. And this helps us to manage the risk within the firm's risk appetite. How do we tolerate such risk, or how can't we? And then it helps us to provide reasonable assurance that we can achieve our firm's objectives. Okay, so the definition has a number of elements that we need to consider. It focuses on managing risk by recognizing our culture, develop capabilities and processes and structures, procedures to manage it, apply them in practice, and then integrate them within our overall strategy and performance. And the idea here is that we want to maximize value, link it to the value, okay, so that we can achieve our corporate objectives. Now, the Institute of Internal Auditors also have a definition for ERM, and they consider it a structured, consistent, and continuous process across the whole organization where they identify, assess, and decide on responses that they could use to maximize the opportunities and to reduce the threats that could hinder them from achieving their objectives. Okay. ISO 31000 also gives us a definition where it talks of risk management referring to coordinated set of activities and methods and practices which are used by organizations to direct and to control these many risks that can impact their objectives. Okay, so we have a number of definitions we could look at for. So in real terms, you don't need to stick to one. Try to understand the concept. In your own words, you can couch something out, but you could also most importantly stick to these technical definitions. It has evolved. ERM has evolved over time. And first, we need to look at it in before pre-1947, organizations will use their own traditional risk management processes to manage risk within the organization. By 1947, the ISO was established to help standardize these risk management processes. In 1973, we had these non-life insurance directives, and it was considered as a format point for solving solvency requirements. Cash became the main thing people looked at. So in 1974, there was the establishment of the Basel Committee. And again, their main idea here was look at international currency and banking. Cash, liquidity, became the main priority, but it has evolved. It's no longer cash. It's no longer capitalism, where we only want to think of capital, money, cash, profits. No, maximizing shareholders. Now, in 1980, companies began setting up their risk departments. So during this time, people were looking at not only risk from financial, but a whole portfolio of risk that could affect them. So this led to the Basel Capital Accord Basel I, which was set up. In 1992, the COSO published its integrated framework on the risk management. Okay. Now, again, in 2002, you remember because of the failures of these so-called auditors, big auditors, defrauding the system, the US put in place the SOX Act of 2002. Again, in 2004, there was the release of the COSO ERM Framework, or the Basel II, okay, Accord. Now, in 2009, again, the ISO 31,000 was also put in place, was established. From 2010 up to now, what we have realized is that in 2010, the Basel III norms or reforms were introduced. In 2013, the COSO also brought in some internal control integrated framework, updating normally, I think, the initial integrated framework. And then from 2017 up to now, we have the enterprise risk management, which is integrated to all aspects of the organization, not just cash or liquidity. Okay. Benefits of ERM are many, and the list you find here are not exhaustive. You could find some more. So it helps in reducing negative outcomes, in identifying and managing risk throughout the company. It helps us to identify ranges of opportunities we could capitalize on, helps to reduce performance variability so that there could be some standardization. It helps in improving resource deployment to make good use of our resource and cut down on unnecessary cost. Okay. Enterprise resilience is ensured, and then it enhances decision making by integrating risk into the overall strategy and performance of the organization, and helps organizations to also have focused attention on significant risk and forget about this low risk which may not have enough impact on the organization. Now it helps us to all speak the same risk language, and we all understand this same risk language in the organization. And one more thing is that it leads in effective cost management in the organization. Okay. Key principles of ERM. The COSO framework provided some principles. One, consideration of risk management in the context of business strategy. Two, everyone's responsibility, but it starts from the top. Those are the top. We should create a risk awareness culture throughout the organization. Not only a few people should have that prerogative. And a comprehensive, holistic approach should be adopted in risk management. Don't consider only the finance. Consider everything: reputation, operations, long-term survival of the organization. Consider everything and include a broad range of risks that could affect the organization. We've seen the sources of risk, so all this must be included. And again, it must be led by the board, by the senior management. Okay, it should be strategic, not short-term, intermediate. No, it should be strategic, long-term. Okay, and it should be spearheaded by the senior leadership team. So the COSO ERM framework has three different blocks. Let me put it that way. So it has four objectives: dealing with strategic objectives, operating objectives, reporting, and then compliance. And it has four organizational levels, which deals with the subsidiary, business unit, divisions, and entity level. And it has 8 core elements, components, which deals with our internal environment, setting an objective, event identification, risk assessment, risk response, control activities, information and communication, and monitoring. We have some articles online. I would suggest that take a good look into all of this so that you find a detailed information on all of this. Okay, so this is just a synopsis of what we've providing you. So take a look at this. You could be examined on this too. You could be asked to identify the 8 ERM framework and discuss how it applies to a particular scenario. Okay, so don't just list it. You list them, you get like less than quarter of the mark. Okay, but you identify and you explain critically. At our level, we need to be able to critically evaluate some of these. Okay, now in risk management strategy, whenever we want to formulate risk strategy, we need 4 key factors which play a key role, and we need to always identify them. One, what is the risk appetite of the company? How can we entertain or tolerate this risk? What is our tolerance level? Do we have the capacity to bear this risk, to control it? Okay. And what is the attitude of the organization overall? Are we risk averse or risk seeking or neutral? Okay, there could be neutral, some but rarely. Okay. And then finally, what is the residual risk that we think that no matter how many controls we put in place, this cannot be solved? Okay, we should also consider that businesses could always have some risk no matter how many controls you put in place. So these are the four factors that play a role in formulating a risk management strategy. Now there's there are some characteristics of the risk management strategy which we need to identify. SEMA and IFAC joint report in 2004 identified these characteristics. One, there should be a statement of the company's attitude towards risk. What is our attitude towards risk? How are we balancing risk and how to achieve our objectives? What is the risk appetite of the company? What is our objectives in terms of our risk management strategy? What is the culture of the organization towards risks? Okay, and who are responsible for what risk management procedures in the organization? References should also be made to the risk management system that we use. Do we have a robust internal control system or some standard operating procedures to minimize or to control risk? And then also look at performance criteria. This must be defined. Who does what again? And when do we want to evaluate whether these performance criteria achieved the risks or not? So that if there is the need to modify, we can modify them. Now, there could also be an alternative process for risk management, and this is suggested by the Institute of Risk Management. Very key, they are in charge of this particular element of enterprise risk or risk management. So they identified 3 elements as alternatively what we should consider. 1, risk assessment. So identify the risk, describe it, estimate, quantify it if possible. 2, then report it. Okay, report it in your bulletins, in your annual reports to the shareholders. Okay, put in some monitoring controls to assess these reports. Okay, and then finally treat the risk that you've identified and reported. Okay, whether you want to clear them totally, you want to share them totally. Okay, and then identification of risks. Normally, you can see a risk manager in charge of this. You can also have a risk committee. Some organizations will have the audit report implementation committee serving as both the risk committee and then the risk and the audit committee. Okay, so they look at both sides. Then the risk which have been identified should always be recorded in the risk register. It's very important to always record these in the risk management, in the risk register, so that you can control them. Okay, many methods can be used. A number of methods could be used to identify risks that an organization faces. Now, when quantifying or estimating or measuring risk, there are a number of formats we could use. We have the expected values where we sum the probability by the outcome. Okay, we have the volatility which looks at the downside and the upside. Okay, so we look at outcomes which would come. What is the downside? Downside losses that we incur, upside profits that we make. Okay, so for example, a company has these estimated sales with the following probabilities for December 2021. How do we calculate the downside and the upside volatility from expected sales? So expected sales is like the mean, the average. You remember this computation, this calculation. So we multiply 35% by 750,000, 45% by 925,000, 20% by 550,000, and add all the answers together. Okay, that is the expected return. That is the expected return. Now, in terms of the volatility, look at the downside. Pick the lowest expected sales, which is 550, and subtract it from the expected return of what we had, 788, 750. That is 238. It means that is what we could lose. Okay, that is what we could lose. And then take the upside, the highest sales that we will make, the highest sales that we could make, we've estimated, and then subtract the expected return, the average from it. It's like finding a mean deviation. Okay, and what do you get? 136. This is the upside. It means we could possibly make 136 extra profit. Okay, on the upside, given the average that we have found. Okay, we could also use standard deviation to look at the dispersion, but with standard deviation, it will give you only one figure, and that one figure could be the upside or the downside. Okay, so you have your expected value or the expected outcome, and the standard deviation could be like 120,000. So it means you could lose 120 on the upside, or you could gain on the downside, or you could gain 120 on the upside. Okay, so standard deviation measures the risk. Sometimes you'll not be given a standard deviation, you'll be given the variance. Remember, variance matches with standard deviation. Variance is more like the bigger brother of standard deviation. So variance is always seen as the square of standard deviation. And standard deviation is the square root of variance. So if you are given the variance, you just have to find the square root of variance to get the standard deviation in order to measure the risk at hand. Okay. We could also have value at risk. This tells us that for the whole portfolio we are looking, which value can we lose? Okay. So for example, if we given a situation that there is a 90% chance that the value will fall by 10 million over the next week, value at risk is to find the standard deviation which measures the risk times the appropriate z-score from normal distribution. Okay. Regulators will normally, like banks, will use the VAR as a measure of risk. Okay, so to illustrate the VAR, okay, to illustrate the VAR, we could look at a company, they sell outside, okay. Now this company sells on credit, they've invoiced 12 million. The exchange rate is given as 1.1996 euros to the pounds. The volatility is given as 0.5. That is the risk, okay. So to find, and then they want to the nearest pounds, 1 day, 90% VAR. So exchange the 12 million to pounds. We get 10 million roughly. Multiply the rate 0.5 to the 10 million, you get 50. And then since it is 90%, you use the normal distribution table. 90% corresponds to 1.645. 95 corresponds to 1.96. 99 corresponds to 2.576. Then you multiply this normal distribution probability value against the 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 risk that you found. Okay, 50,000. So on the average, we could have 82. No, standard on a standard basis, we could get 82,000 being the value at risk from this particular transaction. Okay, from the 10 million, we could lose 82,000. All right. So again, quantifying, we could use regression and correlation analysis. Okay. We could also use simulation scenarios to also find, we make some assumptions and see whether it falls within. So the regression coefficient will talk of the sensitivity of the company's cash flow to this risk. Okay. Correlation will also measure the strength of the relationship. Okay. And simulation, we try to use probability distributions, of course, and then we calculate expected values by making some assumptions. Risk mapping. Typically, it is done by those at the top. Internal audit normally also do some of this. But what we are looking at here in risk mapping is to prioritize risks in the company. And usually the risk map will normally look at the likelihood and then the impact. So it's a function of the likelihood, the probability, and then the impact. Okay. So if there's a low probability and the impact is low, these are low risk, we can accept them. But if the probability that it will occur is low, but the impact is high, you should examine this. Why? Why is it that the probability that it will occur is low, but the impact could be high? For example, if there is flooding, what is the probability that there will be flooding in the central bank or in the Buckingham Palace? It's low. It's low. But if it happens, what is the impact? Significant. So you need to further examine this. High probability, but low impact. Similar scenario. Probability that it will happen is high, but when it happens, it's low. Examine it. But if there's a high probability and a high impact, you need to consider this to be a significant risk and monitor it closely. So there are principal responses which we could use to assess these risk strategies. Okay. First, the main important thing is the principal objectives which we could put in place to develop risk responses to minimize our risk exposures, to avoid unnecessary risks, to take actions to control any risk we identify, and to ensure some balance between risk and return. Okay. But what are the methods we normally adopt in terms of risk management treatment? Okay. We avoid risks which are significant. Avoid them. Risks which you know are high, significant. Avoid them. We transfer some risk when we think that we cannot bear all. So give it to an insurance company. We could also pool risks together. When we are all together and the risk occurs, the impact will be low. So consult other people in the organization and see how you can pool all together, or even within the sector, and see how you could pool sources together. And again, we have diversification. Totally diversify. If you think this area you are dealing with food product, meat, and then you can see people are now switching to vegetarianism, you need to also divest. Okay, you have to just invest in those other areas to ensure that you are not at risk. And then we have risk reduction. I think all these three are risk reduction. So with risk reduction, put in strong internal controls to reduce the risk. You could also hedge in terms of these financial transactions so that you reduce the risk. And you could also share, again, call for an insurance company or a joint venture approach so that you could share these risks. All right. Now, we've looked at this, but there's this thorough approach. Transfer the risk, okay, partly or in full. Avoid the risk, those which are significant, which could affect, avoid it. Reduce the risk if you think you have some risk appetite to accept the downsides, okay, and then accept it if it's very low, okay. So low probability against high impact, transfer or share it. High probability, high impact, significant risk, avoid it. High probability but low impact, reduce it. Reduce it. Low probability against low impact, you can accept it, okay. This is what we call the Tara risk management approach. Risk reporting. Now in the UK, it is required. Every organization, especially those who are listed on the stock market, must disclose their risk reports in a separate report, or normally as part of their annual reports. Okay, and this risk reporting should include a systematic review of the risk forecast, at least annually. Some do it semi-annually. Look at the risk strategy and responses. How are you monitoring and providing feedback? Do you have any system indicating material change to business circumstances? Do you have any early warning sign? Okay. And incorporate audit work as part of the monitoring. So if you have a strong internal audit system, they could take up this. Now, in the risk reporting, there are two elements we normally have to show: gross risk and net risk. It applies like in gross profit and net profit. Gross risk means those risks that are prevalent when there are no controls. Okay, when there are no controls. But net risk or residual risk are the risks that exist even after we've implemented all the controls. Okay, every organization will have some residual risk no matter what. They will always have a residual risk. Okay, so take a look at the residual risk, and they should always be measured as a portion of profit, capital, or turnover in order to help us make decisions. If the residual risk is significant, then you are out for some big trouble. Okay, so the company should then be able to know, can we bear this risk? Okay, how will it affect our returns, shareholders' wealth, the operations, the going concern prospects of the company? Finally, what we want to look at is who is responsible for what. Board of directors, they are the top, they set the tone, they define the risk appetite, they move us as overall over responsibility of those charged with governance of the organization. Audit committee, like I said, audit committees could be infused into the risk committee. Okay, if that is the case, then all of these responsibilities affect them. They work with the board, they work with auditors, internal auditors, external auditors, to ensure the risk management processes are working. They create the risk awareness, they establish policies for risk management, they ensure adequate existence and efficient processes to detect and report risk. They update the company's risk profile. They report to the board and make recommendations on the risk appetite. Secondary objectives of these committees could also be acting on behalf of the board, advising the board on the risk profile, implementing audit recommendations, ensuring that proper mechanisms are in place to identify, to assess, and to report and treat risk. Okay. And they also look at continuous review of the company's risk management policy. And they must also ensure effective communication of these policies to everyone in the organization. Okay. Now, internal audits, they work with management, review internal controls, and support management to implement these risk management processes. And we could also have a risk manager or a risk management group. They help in also providing overall leadership for the risk management. They also identify, evaluate, and help to treat risks and implement risk management strategies. They also look out for opportunities where we could capitalize on these opportunities, or we could reduce risk. They monitor the risk management mitigation strategies, okay, and internal audits. They develop, they implement, they manage risk. They maintain good relationships with the board, with the risk management, and with everyone, okay. They work with insurance companies to help share or transfer these risks, and they must also ensure that company complies with all business laws, regulations, and compliance protocols. To everyone in our organization, it is our responsibility to be aware of risks and to be audible enough. If you need to blow the whistle, serve as a whistleblower to save you and your colleagues from any future harm. Now, looking at final options, evaluating a risk management strategy. First, once the company has a risk management strategy, they need to establish the strategy as the first point. Once they have this, they should also identify areas where they could reduce the risk and areas where methods which they could use to achieve this desired result. Two major questions now must be asked whenever we evaluate a risk management strategy. Have we achieved our objectives? Do the benefits outweigh the cost? So it's always important to undertake a risk cost benefit analysis to ensure that the costs do not outweigh the benefits. Okay. Benefits from risk control should preferably be measured and should be quantified where possible. But of course, some of them can only be assessed qualitatively. We can't put numbers on them. And then the evaluation process should be based on principles that the cost should not exceed the benefit. All right. So that is it for now. So that's great. We've managed to treat that one as well. And I think you should take your time. There's some questions on the VLE, tutorial questions on the VLE. In this scenario, we had only one, but there are some more questions there which I will entreat you to look at, and then, of course, the solutions will be shared for us all to review. Great. And also, there are some readings which have been put on the VLE. Please take your time and read some of these articles. It gives us some more insights, and it helps us in our final assessment and final exams. Okay, see you soon. Thank you.